Hi everyone. The relative value of U.S. commercial real estate will continue to be a major focus for institutional investors in 2026. It's no secret that the return performance of multifamily since the pandemic has trailed that of the stock market. From the first quarter of 2020 to the third quarter of 2025, the S&P 500 returned 181% cumulatively, a 21% annualized rate of total return. By comparison, apartments within the NCREIF Property Index only returned 27% cumulatively, a 4% annualized rate of total return. Driven largely by major technology firms, the post-pandemic run-up in stock prices means public equities are richly valued relative to private commercial real estate. For example, the S&P 500's dividend yield is the lowest since the early 2000s, barely above 1%. In contrast, apartment net operating income constituted about 82% of total annual return for the past 12 months. Now, institutional investors, like pension funds, must maintain a diversified portfolio of assets. But they are making decisions around where to put investment capital to work in 2026 based upon relative value. Comparing apartment return performance to the public equity market over the longer term, it is clear the multifamily sector stands the test of time. Going all the way back to the start of 2000, cumulative total return for NPI apartments has been 547% versus 615% for the S&P 500. Keep in mind that property returns are unlevered. Though over the long term, public equities have outperformed private real estate, it hasn't been by as wide a margin as seen earlier, and those returns have come with a lot less volatility. Commercial real estate has faced a host of challenges since the pandemic, including dramatic swings in demand, oversupply in certain geographies, and higher borrowing costs. Combined, these have caused a 16% decline in national apartment value from peak. That correction has put the total return trend back in line with its historical average, suggesting the current return trajectory is sustainable. For more than a decade, investors have maintained an 11% target allocation of their total portfolios to commercial real estate. Recently, some large investors have announced they are increasing their allocation as high as 14%. Aggregate capital raised for U.S. real estate fund strategies is over $120 billion for the year through December. That amount exceeds both 2023 and 2024 full-year totals and suggests that institutional investors see opportunity in real estate relative to other asset classes as the flow of institutional capital into real estate is picking up again. This will keep upward pressure on values, although investors still need to be cautious as policy uncertainty remains elevated. Selectivity continues to be key, and investors must be alert as there are significant property performance differences between vintages, markets, and submarkets. But with investment horizons of 5 or more years, most institutional investors continue to view commercial real estate, and apartments in particular, as portfolio mainstays.